we're not really tied to the Fed rate. I think that's important that people kind of realize. So for us, it's more an indication of what's going to happen with the economy.
A 6% mortgage rate is acceptable to that. So people are getting used to these higher numbers.
And well, that's why I'm here, because I am the voice of the audience. Hey everybody, this is Lexi Romano, and we are back with another podcast of 1912 Capital's Deal by Deal. I'm so honored to be sitting here with Damon and Court from 1912 Capital. So since this is technically going to be one of the first podcasts we release, do you both want to take a minute to talk a little bit about 1912 and what everyone can expect from the Deal by Deal podcast?
Absolutely. You want to go first?
Thank you. Yeah, you said absolutely. I thought, great, it's going to go first, and then you're turning it over to me. I see how you are.
See how you do.
I should have expected that kind of thing. Yeah, no, we talked to a lot of people all day long. We talked to a lot of investors, people that want to invest with us, people that are borrowing from us, and Court and I are maybe a little bit older and have got a little bit of life experience. So we just wanted to put together a podcast where we can talk about the market, what's going on. What do we see from borrowers, maybe that is, best practices, things that maybe sometimes gets them in trouble. Talk about some of the deals that we've done that we liked. And, when we have guests on, talk about deals. That's why we named it Deal by Deal.
Yeah.
Right? Because everybody has that one deal that got them hooked into real estate. And they love to talk about it. So we'll talk about that a little bit. And, current events, how the market's moving, just a little bit all of the above. And I would say we're still figuring it out a little bit. Wouldn't you say, Court?
I would agree 100%. So this is a test here. We'll see how it goes. We hope you guys enjoy it. We kind of thought that this was a good thing for mostly education. That was our goal, is we really want to educate investors in general. Not only our investors that invest with us, but just real estate investors, house flippers, people that are considering, looking at real estate markets or lending markets or things like that, that are unique. And so hopefully we're kind of a fun group that we can hang out and chat and educate and entertain you at the same time a little bit.
And well, that's why I'm here, because I am the voice of the audience. Someone who's more of a layman, more of someone off the street, a pedestrian who can come in and ask the questions. So that is definitely why I am here. But thank you both so much for having me again.
Absolutely.
So let's go ahead and dive right into what's going to be our first topic today.
Well, first, we need to congratulate you, right? What has changed in your life in the last 30 days?
Yes, well, thanks to your support, and you guys have been wonderfully...
Yes, we were critical.
You guys have been...
I want full credit.
Yes, I'm giving it. I'm here to give credit. No, you guys have been wonderfully supportive of me pursuing the title of Mrs. Arizona, which I achieved. Thank you so much. So yes, I'm walking that path right now and get to go compete at Mrs. America in the very beginning of September. So
awesome.
Yes, thank you guys for your support in that.
Yeah,
thank you.
It's a really big deal.
Yeah, it's very fun. But getting to more important current events, let's talk about the Fed rate.
Okay.
Whoever wants to jump in on this first, kind of explain a little bit about what's going on, how that affects 1912 Capital, and then how that trickles down to investors, or if it does trickle down to investors.
I'm going to go first because I forced him last time. So the Fed rate. Just decided, I think, last week. It was the first vote with the new Fed president.
Yeah.
And it was 12-0, which I think is interesting, to hold the Fed rate steady. So I think that that's kind of what was anticipated and what we kind of hoped for too, I think, because I think it's good to just stay stable and steady for us in our industry. A lot of people think that rates are high, and they are a little bit high to where they've been, but they historically are still very low.
Yeah.
And so it's interesting because what the Fed's always trying to balance is, inflation with demand and ability to borrow money. And so it's kind of interesting. They're kind of in a tricky spot where there's a lot of inflation still going on. Gas prices, the war in Iran, obviously driving gas prices high. Yeah. And job numbers too. That's a big thing that they're always trying to balance. So jobs have actually been increasing too again, which is great. A lot of people are worried about AI and what that's going to do to jobs. And so they're in a tricky spot where there's just, people on both sides.
Yeah.
Well, they kind of signal too in their meeting that we should anticipate potentially, raises, a quarter point raise the next time they meet, which, just signals that inflation really is starting to get out of control again.
Yeah.
It's, they're, like you said, constantly balancing inflation versus job growth and economy growth. And, I guess they feel at this time that inflation is getting more out of control. So, that's not a bad thing. I don't think for them to raise rates maybe a little bit to slow it down. They did a good job last time, and they raised rates. And actually, I may be one of the only people in America that believes this, but I actually think the Fed's doing a fairly decent job of keeping our economy, kind of chugging along.
Somewhat stable.
Yeah.
And so, Court, you just kind of said this is, you think, a good thing. And I remember talking to you about this a couple weeks ago, the last time I saw you, that you do think the Fed rate staying stable is good. But how does that affect investors, or does it?
Well, it definitely does. It affects everything because the Fed rate really is what is the rate that banks borrow money from the government at, and so it affects. Just has such a large downstream component, right? Everything gets affected by it. Mortgage rates in particular are not specifically tied to the federal funds rate. That's a kind of a misnomer that people think that they are. And in fact, the last couple of times that the Fed has dropped rates, mortgage rates have actually gone up a little bit. So they're not directly correlated, but commercial loans, car loans, student loans, basically everything else besides mortgage rates kind of tied to the Fed funds rate. And so everything gets more expensive if you're having to borrow when the Fed keeps rates higher, raises them.
Yeah, absolutely. Okay, so did you guys want to talk any more about the Fed rate? Is there anything else?
No, I think it'll be interesting to just see where it goes in the future.
Yeah.
And as he mentioned, with it not being tied to mortgage rates specifically, it's really not tied to our rates. So I think that's important with 1912 Capital. We're a private lending company. We are very much a fixed rate that's been stable and steady for the last 3 years and probably will be for 10 more years, which is interesting. And the reason for that, I think, is that it's really more tied to a line item on our house flippers budget. We're not really tied to the Fed rate. And I think that's important that people kind of realize. So for us, it's more an indication of what's going to happen with the economy and how fast are our flippers going to be able to sell their houses to the end buyer that then does need that mortgage that is going to be affected by that rate. So it does play into our business model, but it doesn't actually affect our rate. So I think that's an interesting concept.
It affects the psyche of people in general. I think they take that signal as to what is happening right in the economy, and so people watch it. It affects everybody. It affects us definitely.
And it's been slow for sure. Do you think that this will slow it down, or do you think that it will just kind of stay?
I think it's going to stay stable and steady, which is, I think, good too. There's still a $10 million house shortage, I believe, is what the number that's typically reported is. So it's a huge number that's still short of what's needed of housing supply in the U.S. So, I don't think that that the housing market's going to crash with that demand that's still out there. There's so many people that are living with their parents or, can't afford houses, right? Living with grandparents, which is okay too. I mean, it doesn't, maybe that number's not real because it's okay to have multi-generational living too. But it's just an interesting thought that if that number is being reported, we're probably okay for at least a little while here, that even if rates go up another point, it's not going to crash the market. It may lock in the market a little bit, which people that have low mortgages are not going to sell, right? I mean, they're stuck in the home that they're in.
I was reading something though the other day about the percentage of home buyers that they surveyed in this article, and I don't remember the exact number, so I'll quote the statistic wrong, but it was around 50%, just above or just below, that have now said that a 6% mortgage rate is acceptable to them. So people are getting used to these higher numbers, right? They're not expecting the 3s anymore and the 2s anymore. They're realizing that this is the new norm. They're starting to figure out how to work their budgets around that number. And so I think that the market will continue to grow. I think demand will continue to increase slowly. But again, I don't think it's anything that's I'm not expecting some big rush.
It's more of a mindset shift.
Yeah, it is a mindset
kind of
shift.
at the end of the day. Okay, so let's switch gears and let's talk about recent mergers and acquisitions. There's been some kind of big stuff happening in this sphere. Do you guys want to touch on this a little bit?
Yeah, I'll let David go first.
I was going to say, I'll go to tell you, Court, you should talk about this first. How's that?
Okay, well, we have two companies that are in mind that we've seen mergers and acquisitions. The big one probably most people have read about is Taylor Morrison. Huge housing company that most people have heard of, especially here in Arizona, where they're everywhere. Interesting, their buyer was Warren Buffett. With Warren Buffett having stepped down, new CEO, so it's kind of his first major acquisition as the CEO.
Okay.
$8.5 billion, I think, if I'm quoting that number right. It's a big number, but not a huge number for as big of a company as
Well,
they are.
Damon kept saying earlier, oh, it's pretty low.
No, it's not.
It's a bargain. $8.5 million.
$8.5 is cheap. I mean, Elon Musk
For Elon.
is a trillionaire.
Yeah.
So $8.5 billion. I mean, come on, that's pocket change.
Yeah.
We didn't even talk about SpaceX. Let's not even go there. But yeah, if we want to talk about inflation, how about inflation of that IPO, right?
Yeah.
So,
Oh my gosh.
but anyway, it's interesting. So I do think that it's a signal for positivity for our specific market and for investors. Again, it just speaks to the belief from very wise investors, right? Most people believe that Warren Buffett's company and Berkshire Hathaway is going to do smart things. They're buying a housing company, believing they have faith in the U.S. housing market that it's going to continue to grow. For us as private lenders, it may have some impact, but it's probably all positive. It may drive down ARVs a little bit as housing stock goes up, because usually new builds are maybe a little cheaper or maybe a little more affordable. Not always. Sometimes, just depends. It depends on the market, obviously. But that may have some impact. I don't think it's significant or huge, but it's just overall a good kind of, to me, signal.
Yeah, if you look at the way that Berkshire Hathaway invests, the companies that they purchase, they always, they've always talked about how they purchase companies that are stable and steady and have long-term growth, right? They never ever try to, I doubt they invested in SpaceX. I don't know, but they're not trying to, capture the next unicorn. They want stability, consistent returns, and so that's a huge sign, at least in my mind, to the overall housing market to say, we're in a good spot. Let's keep going. Nobody panic. We're just chugging along.
Yeah.
Yeah.
And there was another big sale in kind of your guys' actual sphere. Did you want to talk about that, Damon?
Yeah. So the largest company in the private lending space, the residential private lending space, sold just last week or earlier this week to a tech company. It was the first big sale in our industry, so it's kind of really a momentous event for the industry. I think it just shows that our industry is maturing. It's becoming more and more commonplace. It's not just, one guy with a little bit of money that's trying to, that will lend money to his friends. It's becoming more and more institutionalized, which I think is, overall really good for the market. I think it establishes it. And the fact that people were able to, willing to come in and buy that company at the numbers that they did, which were high, I think it signals that, the marketplace, the industry is starting to get more legitimate and be more recognized. So I don't know how it affects us though, because they operate so much differently than the way that we do. But we're going to say something.
I was going to argue a little bit when you say the number was high. Okay. I thought the number was actually low for when you look at multiple.
On the multiple.
Yeah, I thought that they would have had a little more value. It was, I think, around a 7x multiple, which if you're in the mergers and acquisition space, that's kind of in the middle of the market.
Yeah, it's not
low for a tech company for sure.
Yeah.
Anyway, but it's an interesting number to me. It was, a reasonable number, I think.
Yeah.
And it did kind of allow us to see kind of more into their business too, because then it was kind of more public data.
Yeah.
I think they'd originated $1 billion a year in loans. I mean, it was
more is more than that.
Yeah. So they were a big business, in this private lending space.
And what do you think about the fact that it was a tech company?
Well, I would add to that too. It was a crypto tech company, which is really interesting to me. So it's like tokenization. They did have some lending already too, that they were kind of a lending company through what they call tokenization of crypto. But they were more in the historical HELOC. I think they were in the HELOC space and first mortgage. So, this is not consumer lending. We're not consumer lenders. Typically, we are commercial lenders that are doing, house flippers and bridge loans, construction, so business to business lending. So it is different. So for them, it's kind of a shift. But it just shows that probably for them to grow, the easiest thing was acquisition.
For sure.
So,
for sure. And I think though, it also, the lender that was purchased, I mean, they were a tech forward company for sure, right? They were some of the first ones to do a lot of the, automation of things and that sort of thing, and become tech forward. And so, and then I think they would even tell you they can kind of consider themselves a tech company that was in the lending space.
Yeah, I think
I've heard them
their founders say that.
Yeah, we've heard them describe themselves that way. So it sort of makes sense there. But I think the fact that the buyer was a tech company just shows that as the industry matures, it is going to become, much more tech savvy. And I think that we are we're taking steps to become that way ourselves at 1912 Capital, even in our own little niche. We'll never be, well, never's a long time, but we don't anticipate being, you know, like, you know, totally tech forward, right? At the end of the day, we are relationship based and deal based and everything that goes along with that. But
and I think we've talked about this before, where there's a really great balance that you guys are achieving here at 1912 Capital, that there's the automated side of things and you're getting all of that into place, but still having that face time with people, with your investors, still having boots on the ground. So there's a really great balance that's being struck here.
Yeah, and I think it's necessary. I think, you know, especially for us, because it's very relationship based, this business.
Well, and we were just on, we met with our mastermind yesterday of other lenders about our size, and we discussed this topic, came up to this sale. And, you know, there is a need for the larger, you know, lenders like this one that was just sold, that people can go, and the rates, frankly, are less than what, you know, groups like ours can offer. We can't compete with them on that. But what we can compete with them on, and where we exist and where we will continue to thrive, is based on that service and maybe a little bit more hand-holding for somebody that is just starting out or is trying to expand their business. You know, we can come to them, we can help them evaluate their deals a lot more, versus just, you know, filling out a form somewhere, sending it in, and then having, you know, somebody come back to you and say,
response.
yes or no, right?
You become very institutional, right? The larger you get.
Yes.
So most people come to private lenders because they don't want to deal with an institution like a bank.
Right.
So, you know, that's the problem, is if you become the biggest private lender, you've become an institution. And you've shifted, which is okay.
Which is okay. I mean, a lot of people
different.
need that, and you know, a lot of people are happy to deal with that for the price of their product, but not everybody is and willing to.
Yeah, it's interesting.
Do you guys want to touch on any other current events?
Let's talk a little bit about the war, I think, because it's an interesting one that impacts everyone for sure.
Is it over?
So.
Is the war over or not over? Or?
We don't know, right?
I know they did a DocuSign, so that's
but MOU, Memorandum of Understanding.
But then I read this morning that they said that because of it continual fighting in Lebanon, that maybe the truce was off.
Out.
So
Wow.
So,
no, we don't know. We don't know if the war's over or not. We hope it's over, right? I definitely think it does play into just the economy, though.
Yeah.
Mostly through gas prices, would be my argument.
Yeah, gas prices, and then just everybody's mental shift. They don't know what's going on. They're like, hey, well, how long is... It's one thing for gas prices to go up for a couple of weeks. People will deal with that. But if they think that now this can be continually $5 and $6 gas, then they got to start cutting back on other things. People can't... That's a big hit on people's, you know, personal income. So
yeah, no, absolutely. So I think it's a good thing, you know, that obviously it's hopefully wrapping up.
Yeah.
And I do personally believe that it was a worthwhile endeavor, just because I don't want to be bombed by a nuclear weapon, and I don't want to see Europe bombed by a nuclear weapon, and you know, I get the reason that our country was willing to take on this battle, but yeah. So I hope it's legit and that it really is a peace accord that goes somewhere. Yeah. So.
Yeah. Yeah, I think we all hope for that.
From our business side, though, I think it's just going to be knowing what's happening.
Knowing what happened. People want to be able to make long-term decisions, and with that hanging over everybody's head, it's kind of paused.
Do you feel hesitancy because of that in your business?
You know, I would say we don't feel a ton of hesitancy from our borrowers, but I will say that when they're selling their properties on the back end, it's taking a little longer than it was. And, you know, people are just, you know, they're evaluating a lot more. The decisions have become more calculated and less emotional, which is probably a good thing.
Yeah,
you know?
long term. Yeah.
But you know, everybody just feels like they're just slowing down.
Just slowing down, taking a little bit longer to evaluate. As we talked about with the Fed rates, this is something that people have to now budget a little bit more for. People have to think about these numbers a little bit more, rather than being like, I just love this and I'm going to make this emotional.
Or, you know, 15 people are going to buy this if I don't buy it today. So
if I don't go 20K over or 50K over, it's taking a little bit longer, and it is more of a buyer's market, but it's even still, the buyers they're taking their time. Yeah, even when
I do think it's smart. I like stable, steady. So.
Agree.
Okay,
thank you. I think this was really fun.
Thank you. This was really, really fun. Do we want to get into, since the podcast is called Deal by Deal, do we want to get into our favorite deal?
Yeah, absolutely.
David, I heard that you had one.
I don't have one in mind, so it's got to be David.
Sure, I'll talk about the first deal that I did.
Okay.
When I was 22, I had a friend that was moving, and he bought a property, had not lived there very long, and so if he were to put it on the market and sell it, he was going to essentially lose money. He was going to have to come out of pocket because he just hadn't gained any. He didn't put any money down. He hadn't gained any equity because he hadn't held it very long, and so we did a wrap mortgage, which essentially means that I took over his mortgage payments from him, and he assigned over the house to me. And
also known as a sub 2.
Also known as a sub 2, or
you're a Pace Morby fan.
A bunch of different wrap. That shows my age, right? So
no, I was just gonna say I don't know. I've never heard of wrap mortgage.
Yeah. So basically, we were able to arrange it to where he did not pay off the mortgage when he sold the property to me. I was able to take over the payments and continue to make the payments on the mortgage.
Interesting. Okay.
And is that legal?
It is legal.
Okay,
it is absolutely legal.
But there's always a but.
Most loan docs do have a due on sale clause. So you are taking the risk of whether or not the underlying lender decides to call that due. So there is that risk to it.
But people do thousands of them every day.
All the time, and it's there are a lot of prominent real estate gurus that are teaching this method, and a lot of people that we deal with, a lot of our borrowers are using this in some shape or form. So it's
Is it a little bit? Both used it. Is it a little bit of like a roundabout way to get into something?
Yeah, it's creative finance.
Yeah,
it really is.
I like that term.
Yeah, and so for me on this deal, I was 22. I didn't have very much money. He was behind. I actually used a credit card to catch up his payments.
Love it.
And took out. I literally went and got a piece of wood and some paint from Home Depot, and I got their Oops colors. So it was like my sign was the color of your jumpsuit there last week. I mean, it was purple. It was purple.
Wow.
So it was white, and it painted it up, and his handwritten sign
for rent or for sale.
It was rent to own.
Rent to own.
And I put a renter in there, and because it was rent to own, the way that we structured that deal, we were able to get a little bit higher deposit because I was going to go towards their purchase price, and we were able to get a little bit more money each month than the.
Did that pay off your credit card?
Oh yeah.
Perfect. Yes.
The deposit paid off my credit card, so I was back in at zero, and we were able to get a little bit higher rent because they were applying a portion of the rent each month to the purchase price.
Yep.
Of course, as it goes, the deal fell apart. The renter was in there for about 9 months. They were supposed to be in there for a year and then buy it. They were in there about 9 months, got behind. We ended up we parted ways in a nice way. And so then, the market by that time had picked up a little bit. So we actually went in and updated the property, did some rehab on it, and sold it, and ended up making about $40,000 on that deal. So,
wow. At 22, 40 grand's pretty good.
No dollars down.
No, that's great.
And purple painted signs. So, we should paint all of our signs purple.
There you go. Yeah. I mean, there's something to that ingenuity of just going out and doing it.
Well, and you're right. As a 22-year-old, that ability to say, okay, I could go get a job. I didn't have any skills at that point. I could go get a job making $40,000 a year, or I could do this one deal that paid me $40,000. I'm hooked, right?
You got the bug.
I was 100% in, and that's when I really dove into real estate full time, and real estate investment specifically full time, and have been doing it now for over 20 years.
Well, that's cool.
Awesome.
I love that story. That's good. That's good. All right. Well, anything else we want to leave the listeners with before we head out?
No, I would just say that, we intend to share a deal each podcast. And we would love to have some guests come on the podcast. If you've got a great deal you want to come and talk to us about, please reach out. And then I'll prepare for my good deal for the next one.
Yeah. And any topics that anybody has that they want to hear about, we'd be happy to discuss them. And, check us out. dealbydealpodcast.com is the website. We will be posting these on YouTube as well. So,
awesome.
Excited you guys are here. Thank you for joining us.
Thank you. Thank you so much.